When we take a look at the indicators, we find that the stock market generally moves up in an exponential manner. Once confidence is created, more and more people get into the market, causing the price to spike higher and higher. There's no slowing down until it pops. You came here for the truth. Today we're going to look at this indicator as well as many others. Let's begin. Diagnosis, halitosis. The S&P 500's 50-day moving average is one of the technical signals to watch as some warn on deteriorating market breadth. So the technical analysis is something that I don't really like to get into too much, but I do believe it's interesting to see those who pay attention to the technicals and they are saying we have some cause for concern. They may use the 50-day moving average, they may use the 200-day moving average, and these are the primary indicators for a lot of those involved in the technicals. I think it's interesting just to see it the way that they are describing it and to get a different view of the subject. Instead of always just looking at the fundamentals, we need to look at the micro level as well. I think it's important. Let's move on. Total credit. I thought this was really interesting. I definitely wanted to share it with you because we always talk about a rather significant expansion, an exponential expansion as I mentioned. But in this case here, total credit, it's a little different. Now, leading up into the financial crisis, we had an expansion of credit that the world had never seen before. And that was without QE and zero interest rates. Yet, when they started to interject into this market, giving it the stimulus with the QE, giving it the zero interest rate for 8 long years, actually generated a tepid expansion of credit. And you could see that for yourself. Now, of course, that's a relative figure here. But as soon as that market began to decline, real deflation began to set in. The central banks implemented their policies and they tried to get this market to be kick-started. But the results of which have not been that good in terms of total credit expansion. Now, of course, we had rapid expansion previously, but just imagine what they have done leading up until this point, and they still haven't been able to get to that level that we experienced previously. This is showing you that every dollar printed into the system has less of an effect. That is almost going to happen right away. Not right the next day, but it will happen. It will take an effect quite fast. And that is really showing itself right here in the total credit expansion that we've seen. That's not to say that credit's not expanding, and that's not to say that the central banks aren't going to continue with their policies. That just means that every time they print money, it has less of an effect. Very interesting to say the least. Let's show you this one, all connected in with that. Total credit change as a percentage. And you could see this here. Credit expansion has been far weaker than 1990 to 2008. Trillions in monetary easing and fiscal stimulus plus zero interest rates, and this is a result. This isn't just weak, it's extremely fragile. And I do believe that that is something that is not being addressed. Look, during the financial crisis, everything was coming down. Now it's all a matter of trying to get it to go back up. Get back up to where it was before. The stock market's up, that's for sure. There's no doubt about it. But everything hasn't moved up the way that it had prior to the financial crisis. It's simply we are looking at the stock market going up. That's one of the only indicators that is rising right now, that's doing well right now. When you look at the unemployment rate, we know the truth about that. It's a fact. I mean, even most of the general public knows at this time that the unemployment isn't what they're telling us. So this right here is just one more indicator showing you that credit expansion, that's the way this system works. It's on credit, it's on debt, it's on this fictional idea of wealth. And so we need it to continue. We need to accelerate, but it's not doing that. It's very, very stagnant. And if they decide to bring up interest rates even further, the markets cannot handle it. The economy absolutely can't handle it, but the average individual saver might be able to actually save a few bucks, but we'll see where that goes. Let's move on to the next one. This here is very telling to me. I believe it's the most important chart of the day. NYSE margin debt and the S&P 500 real values adjusted to present day dollars. Look at this. The red line is your margin debt and the blue line is your S&P 500. And what we need to note is that margin debt is increasing significantly. And that shows me that while we do have the market rising, a lot of it isn't actual people's investment. They're borrowing that. They assume that they can do so in order to basically have this wave that's continuing for years now and just ride it up until infinity. But it doesn't work like that. And when the market decides to come down, when the central banks pull the liquidity from the system and cause this crash, this will drop much faster than it rose. It happens every single time. You could see this right here, just with the S&P in the previous instances, and perhaps I'll do an entire video about that. But what we will have is a very rapid decline in the margin debt, in the fact that people will have to give up what they've had here because they use their own securities, their own equities as collateral to buy more. They are doing so in this very silly scheme that they've devised, and it's all because they believe that stocks can rise forever and ever. But of course we know that it doesn't happen like that. A lot of people know that as well, but they just say that they'll be able to sell when the time comes. Well, you would be one of the very, very few people that actually do that. Look at what happened during the financial crisis. It wasn't that long ago, although it seems like yesterday. And if you think about how many people were hurt, how many people, ended up on the edge of the building when they lost everything because of things like this. Not because they put in all their money, because they put more than they could ever afford. Using things like margin, it is very dangerous. It is something that I do not recommend at all, but yet more and more people are doing it. And you could see that right here in this chart. Good luck. Two very technical indicators here. I just want to very briefly mention these. S&P 500 put skew is at the highest level since 2004, making the price of tail hedges expensive relative to the price of ATM options. It doesn't really matter. All I'm just trying to show you here is that this is yet another indicator that has risen even past what we had seen during the financial crisis. How many times do I mention the fact that we are actually worse off than the financial crisis? But it doesn't matter. As long as the S&P 500 continues to gain, people will ignore reality. That's fine. Please do as you wish. On August 8th, 2017, the total number of VIX call options traded hit an all-time high. This is interesting here. The VIX has been at a very, very stagnant level for such a long period of time. There's been a little blips here and there, but ultimately it is down to such a low level that it sort of seems like, don't worry, the central banks are here to take care of everything. That's the general view of traders, of analysts, of those in the financial industry. If anything goes wrong, the central bank will be there to be the lender of last resort, so we have no reason to worry. And to some degree, we could agree with that. There's no doubt. However, what we have seen is that they could have done so during the financial crisis. They could have done so during the dot-com boom and every other crisis before that, but they didn't. Why? Because central banks pull liquidity intentionally in order to cause crises, in order to consolidate power and control and wealth, and they do so successfully every single time. They are able to create conglomerates within the system. They're able to basically nationalize corporations that they want. They're able to eviscerate certain competition and form monopolies, and they do so within these crises. So pay attention very closely as we enter the next phase. If you found this video informative, please give me a thumbs up. Last but not least, if you found these video is informative, I know that you will find my books, The Money GPS and my new release, Global Economic Collapse, even more informative. So check these books out at Amazon. The links are in the description below. Take care.